Example scenario, third-party lead generation. You run a non-exclusive lead site for life insurance. You spend $240,000 per year to run your own PPC campaign, which generates 40% of your form fills. The other 60% comes from your affiliate program. You pay a flat $15 per lead for valid affiliate leads that are sold at least once. Your site averages 140 form fills per day. Some 20% of your leads are from states where you are not allowed to sell them, or have no buyers. The average lead is worth $25, and is resold once an additional 30% of the time. Some 10% of leads are returned as unusable, or bogus by buyers. See figures on page 67. Subscriptions can apply to both services and products. Consumers agree to be billed on a regular basis during the term of the subscription agreement. Often the term only includes the initial sale, and can be cancelled at any time in the future. The value of a subscription lies in extending the term of it. Typically there is a drop-off in customers each time a billing event occurs, as more and more customers cancel their subscriptions. Subscription businesses that do not add a lot of real value are in a constant race to replenish the ranks of their customers before existing ones cancel. Example scenario, subscriptions. You sell a unique natural weight loss pill manufactured under contract through a dedicated website. You offer a free 30-day trial of the product for a $7 shipping and handling fee billed to the client's credit card. Some 40% of trials become paid customers, who will purchase an additional 3 months' worth of product after the initial trial. Each monthly supply sells for $30, including shipping and handling. The cost of the pills is $4 for a month, and the shipping and handling adds another $4. 100 new clients per day sign up for the trial. Half of your sales come from affiliates to whom you pay $20 for each new customer. An additional 25% of sales come from your PPC campaign, on which you spend $120,000 per year. The remaining 25% come through direct typing of your URL by people who have heard of your product name. See figure on page 68 to 69. End of 69. In this example, there is an actual financial loss on the free trial when considering the product, shipping, and affiliate costs. This results in negative short-term cash flow for the business until the money is recouped in subsequent months from refill clients. Intermediate conversion actions. In many cases, the ultimate desired conversion action may occur months or even years after the initial visit or contact with your website. To complicate matters further, there may be several intermediate actions following the initial contact. This is typical of many high-ticket business-to-business sales. In such cases, the website serves as a tool for educating the prospect early in the sales cycle, and identifying who they are. To properly track such activities, you will probably need some way to note the whole history of an interaction with your company by an outside visitor. This may require having some sort of Salesforce automation (SFA) or customer relationship management (CRM) software. Most of the time, as an online marketer, you will not have all of the information required to make decisions. Perhaps the data may need to be periodically compiled for you by other people at the company. This is the riskiest type of conversion action to value. You must make a series of assumptions to arrive at the value of the most upstream conversion action available. This is also your most frequent and least delayed conversion action. Of course, these assumptions should be conservative. In addition, they must be verified once real data starts flowing in. But this is confounded by 3 additional issues. First, the time lag between initial contact and downstream intermediate conversions can be significant, and you must wait until properly aged data is available. For example, if someone downloads a white paper, they may read it immediately, but may not sign up for a pilot study of your product until the next fiscal year's budget has been approved and funded. Second, the number of ultimate conversion actions may be very small, making it hard to determine an accurate conversion rate. Third, the value of each sale can also vary dramatically, making it difficult to estimate the revenue per sale accurately. Example scenario, intermediate conversion actions. Your company sells a complicated suite of special-purpose computers and custom software applications aimed specifically at managing human resources for large state and federal government departments. The sales amount depends on the size of the installation and the specific modules that the customer orders. It can range from $100,000 to $10 million. The product is sophisticated and requires a lot of education before a prospect understands the full benefits of your solution and how it differs from those of your competitors. 10,000 visitors per year to your website will give you their contact information to get an informational white paper about human resource management systems like the one you sell. All of the website traffic originates from a PPC campaign costing $20,000 per month. After downloading the white paper, visitors start receiving ongoing informational emails that cover developments in your industry and encourage them to contact a sales representative. Some 8 to 10% of people on your email list will eventually contact a salesperson. Some 20 to 25% of sales contacts will lead to free trials. About 15 to 20% of free trials will continue on to become paid sales. Your CFO cannot give you accurate variable cost percentages, but instead provides you with the following information based on last year's annual report. Your sales salaries and bonuses equal 10% of your revenue. Customer service is approximately 25% of revenues. Hardware and the cost of configuring your systems is 20% of revenues. See figures on page 71 now that you understand. Your landing page, let's take a closer look at the people who visit it. In the next chapter, you will get a much better perspective on your online audience.